things were getting a little long in the tooth. So I put it on the market and sold it for $1.6 million cash to a group that was part of a Buddhist temple group in Hawaii. They bought it cash with a quick close. And I then took those gains and rolled them into a 1031 and bought a 60-unit apartment complex in Houston in 2018. So total return, cash flow, plus the cash out refinance, plus the gain on sale, I made $1.2 million with basically zero money in the deal after 3 years through getting my money out on the refi.
Yeah, so John went through a lot of technical terms, so people that might be new, right? So talked about the first deal. First of all, I'm really surprised that in 2008, a 7-unit was still that expensive in Hawaii. I would have expected, I mean, yeah, it's kind of gutsy, right? You're still paying up more than a house costs here in Texas, right, per unit for an apartment out there. So kudos to doing that. But, you know, as John mentioned, 7-plex. They did a 1031 exchange, so it's basically a way to roll profits over into another deal without having to pay taxes on them, right? And again, there's a lot of mechanics. It's a lot more complicated. You know, something that once I do a 1031, John, I'm going to have to come talk to you because, you know, there's a lot of ways it can go wrong and there's a little bit of an art to it. And, you know, so whenever he says pulling out all of his money, really it's, you know, a lot of these deals, you're investing money into it up front, right? You do a refi and you usually get that money back out. So now you have no money in the deal and you own the deal free and clear. Hopefully I hit on all the key things, but John said, but definitely an awesome story. And, you know, there's a lot of those kind of stories that you hear about, right? Where the right deal and the right kind of plan continuously, right? It starts to snowball and carry forward. And one day, John, you got to come down to Houston and take me to that 60 unit. I still haven't seen it in person, man. I've been offering you that for a while and it's just, you know, got to trick you into it.
After COVID.
So if I could just kind of share a couple of the lessons learned.
No, that was going to be, yeah.
Yeah, so I think as I look back, you know, one of the key lessons is buying in the dip. And I say that's important because we're heading into the dip right now. So, you know, I bought that in the you know, downturn in 2008. Well, fast forward to 2020, here we are again. So we are heading into a dip and there will be opportunities. So kind of keep your eye out for those deals. And then I would also say kind of play the long game. You know, don't be a trader of assets, be a collector of assets. And, you know, if you can pull out your cash and still own the asset and cash flow it and continue to work, you know, through the long game and appreciation in the long run, I think that's really another important lesson that I learned on that first deal.
Yeah. If anyone has a good deal right now, come talk to John or Shane or myself. We're all happy to take a look at those because, as John said, it's about being patient, have that, I think, long-term plan. I think some people get in this business thinking it's a quick buck, right? But if you have a 10-year horizon, very different kind of mentality and, you know, put a plan in place and execute, right, ultimately. So, all right. Well, thank you, John. Appreciate that. Shane, actually, sorry, one more quick question for you, John. What did you do with financing across all 3 deals? Were they all, you know, small lenders? Were they, you know, agency, a little bit of everything? And was it easy to do that in 2008? That's my big question because, you know, I wasn't doing real estate in 2008, but what I hear about is really, you know, liquidity dried up, right? And, you know, was it easy for you to kind of do that throughout that process?
Yeah, and it's interesting because it's the same story now that I'm finding with lenders. It was actually a local bank in Hawaii that understood the market and that had confidence in Hawaii and the market there. So it was a bank loan with First Hawaiian Bank, and then continued to kind of refinance throughout the whole time with that same local bank.
That well, nice. All right. Well, then let's see. So Ben, you want to go next?
Yeah. So
same questions, right? And again, John, feel free to chime in and make fun of Ben or tell him about how, you know, he didn't 1031 it in, but he should have, right? And vice versa. So, you know, I want to make
fun of me. Come on now. Too late for that. I haven't eaten yet, man. Come on, take it easy on me. So no, I'll do the same thing, John. I'll start with, you know, I did do some single family before I got into multifamily, but nothing as exciting as multifamily. So my first deal was a 92 unit. Some folks probably know this story, so I won't dive too deep into it, but found the deal. You know, it was a long-term owner, local broker that didn't know what they were doing when they were selling the deal. we pretty much bought it for a song, partnered with a guy out of Houston. We bought it, we rehabbed it. Then Harvey hit, Hurricane Harvey. Luckily, we had flood insurance on it, being that it was along the coast. It was in Beaumont, which is about 90 miles east of Houston, for people that don't know. And, we were able to rehab it, this time putting a lot more money into it. So I think our loan on that deal was about 2.9. When all was said and done, I had put about $2.5 million into it, between what I got from FEMA and what I had originally put into the deal. So you can imagine we were obviously sitting on a ton of equity. So although I agree with John, you have to kind of have a long-term horizon. I think this was 15. We were going to hold it for about 5 years. 2 years into it, knowing what we knew, and just obviously getting kicked around by Hurricane Harvey, we decided to kind of start brokering it, or start looking for a broker to kind of sell it for us. And the BOVs that we were getting back, which is kind of their proposal on how much they could sell it for, was incredible. So, we ultimately put that to a vote, ended up selling it, did very, very well, on that. But, I think ultimately that was a different market, right? Back in 2015. Also, there was a couple other dynamics of that. Once again, long-term, owner whose cost basis was very, very low, if nothing, into the deal. A local broker that didn't know how to properly price things out. I think if I would have bought that from a Houston broker, it probably would have been at least $5,000 to $10,000 more per door. So we bought it at a very good price point, and we were able to really put a ton of money into it, more money than anybody would have ever done, because it wouldn't have made sense to do it otherwise. And then we were able to exit. And so, and ultimately that was able to roll that success into multiple deals after that, because you got long-term investors.
But you did do a 1031, so you should have talked to John about that.
Did not do a 1031. We actually looked into it, right? It's a little, and John, I mean, people are probably more sophisticated about this stuff than I am, but it's complicated when you're doing a syndication.
Yeah, John was easier because it was a little bit.
When it's just one person, or maybe it's just a JV amongst friends, right? It's a lot easier to structure. But when you have 18 different investors, it starts becoming more complicated. So I encourage you guys to, obviously talk to your 1031 advisors on that type of stuff. But, we ultimately decided we even looked into a refi, but it was going to be, a gain of 3.7 or a refi of 900K, and it wasn't even close, right? So we decided to ultimately sell it and, get out of the deal. So in 2.5 years, I think it was 365% return.
So 2 questions for you though, Ben. What, I guess, you mentioned you kind of had a team. So how'd you go about finding that, right? Especially first deal, 92 units, right? Which is a little different than John's kind of path, right? John really kind of chartered his own path, right? And figured it out. You had a little bit of team. So how'd you find that team? And the second question before I move on as well is, what is the mistake did you make any mistakes, or what would you do differently, right?
You're not supposed to ask me the hard questions, man. Come on, we're business.
Our question saved for Michael. So Michael,
all right, good. Yeah, because I was the C student in college. I don't want to know about it. I'm not going to explain IRR. But no. In all seriousness, yeah, I had multiple partners. One main partner was a gentleman that I met through a group here in Texas. We were both local to Houston. He was already in that market. He already had experience, right? I was the one who kind of pseudo found the deal, underwrote the deal, kind of put everything together, raised the money, and he was there to kind of offer his experience. And, ultimately I think that also obviously got me the loan, and, ultimately gave the comfort to the investors that, hey, this guy's partnering with somebody that knows what they're doing, right? My partner had been in the business and is still in the business, and he was at that point had been in for about 25 years. So partnerships are big, for people getting into this. Like, yes, you can do it on your own, right? Like John and some other folks that we know, right? But ultimately, you can probably get to where you want to go a little bit more quickly if you partner with people. Right. Because you're going to be able to leverage their time, experience, and resources. So, that was kind of from a partnership standpoint. What mistakes did I make?
Name the biggest mistake, the biggest one.
The biggest one was, when I look back, I didn't know enough about asset management or really the operational side of running a multifamily business. You're just not. I was in a training program. I'm not going to name names. You guys, the people that know me know which one it was. I didn't learn a lot about that. Nobody really teaches that stuff, and so ultimately, it's hurrah, hurrah. You raise the money, you get the deal under contract, you get it closed, and then you're like, oh crap, now what? Right? And luckily my partner was there for some of the more challenging things. But I think the biggest mistake was just not having that asset manager, component there from the beginning. But luckily the deal had so much meat on it. It was spitting off money. Like we were projecting literally from day one to be able to pay out 17.5% cash on cash. I mean, it was just one of those deals that like I would have had to completely muck it up, to have destroyed that deal. So I got lucky. But, I would say if I was to do it over again, I would have gotten a little bit more experience and maybe had somebody that was going to supplement their experience on asset and operations, into that deal. Right. Because the other thing too is when FEMA came around, I didn't have any experience on how to handle a flood claim, especially of that size. Right. Luckily we had, Dan Kaderka, who's our insurance broker, and a lot of you guys probably use him. He knew what he was doing and he helped us shepherd that whole entire process, but that could have been a complete nightmare, but he sat on the phone with us for, 12 hours a day trying to get FEMA to obviously get the deal done. But yeah, that was another mistake, is just not understanding the intricacies of insurance and some of the other things that kind of go into these deals. Right. But luckily when you have a team and you have partners, you can leverage that experience too.
Mr. Michael, so coming to us live from the train, same question to you, right? What did that first deal look like? How did it work out? What would you have done differently? What mistakes, or if any, right?
Yeah, and I don't know if you're going to ask or going into it later on, but I did look at the chat and I did see a few of the questions that people have, so I'll touch on some of that too. People are asking.
Yeah, feel free to touch on some of them, and at the end, I guess for those that are tuning in late, right, we will do kind of an open Q&A at the end, so definitely type in your questions. I'll read them out loud, and we'll let the panelists answer. And then we'll do a breakout at the very end, right, where we'll break up we have 100 whatever participants on. I'll break it up into kind of groups of 5, 6, 7, and hopefully you get one of the panelists or other people and get to know this. What everyone has said, it's a team sport, right? Some degree, and so get to know the other people around you, what they're doing, and I think the breakout's actually a very powerful part. So we'll definitely do that at the end. But yeah, Michael, feel free to hit on some of the questions and talk kind of through your story.
Sure. Yeah, my first deal was a 68 unit in Fort Worth. And, that was through a broker. It was a marketed deal. It was a deal that probably didn't get a lot of traction with a lot of people that were local to the DFW market, because it was in, a C- area. And if you argued it was a D+ area, I probably wouldn't argue too hard, because it was definitely a rough area. But me being ignorant Houstonian, I kind of went based off of just the data that I was able to gather, versus maybe the people in DFW went based more on emotion, and maybe the history of the project. And then working with Anton Matley, who's here as our mortgage broker, he provided us a lot of key information about the property in the area. And made us realize that this area was gentrifying, that there were, 2,500 units that were bought in the previous 2 years. We weren't at the forefront of trying to turn this area. There were more experienced, syndicators and groups ahead of us that were buying and slowly turning the area. So that made us comfortable with it. But at the same time, it helped us because there was not as much competition. So, so we bought that. It was me and one partner. We were both new into the multifamily space, and but we weren't new to business. I had my business. He's been a serial entrepreneur, and he still had 2 businesses at the same time. And based off of that and our net worth and liquidity, it made it such that we could get a loan from the lender, a Freddie agency loan. Without having the experience there, they were okay because our net worth and liquidity was more than enough. And then similarly, that background helped with our investors. We had been spending the previous year kind of networking and building up those relationships. but also relying on the fact that, our investors knew that we came from a business background, and that kind of helped us be able to raise money for our first deal. And then the fact that, together, my partner and I, we were 20% of the equity of the deal. So our investor, then our lender, was very comfortable with the fact that, we were a very big portion. We were putting a lot of skin in the game. And so that made everybody comfortable to start with us. So I think that touched on some of the questions that some people have. How do you get started?
And maybe to recap maybe to recap a few of the key points, right, that you hit on is, having a mortgage broker who kind of helped you understand that market, what's going on, right? It helped in that aspect. B, you had a partner, right, that you had met, helped kind of carry the load. And C, and I think this is an important one, you were talking to your investors way before you had the deal, right? You didn't just, and I think a lot of people think, hey, I get a deal and then you talk to investors, but really they happen simultaneously, right? And so I think that's another key aspect. And then there was a D, but I don't remember what it was now. So we'll keep going.
Yeah. No, well, I mean, you're right. I mean, I think Anton was very, very crucial for us. He provided us a lot of advice. I give him a lot of credit in making us comfortable and getting us into the right mindset also. So, but yeah, you're right. You got to talk to everyone early on. We were talking to Anton many months before that happened, right? And we were making relationships with the brokers many months before we found the deal, and the broker was comfortable enough to, award us the deal. And same with our investors. We were talking with them many months before that too. So it's a process, but that you go through, and then now I guess all the other syndicators can attest to it. It's a continuous cycle. We're spending all of our days looking at underwriting new deals. We're spending all days, talking to investors for those new deals that we might buy, and then we're spending our days operating the deals that we already have. And it's rinse and repeat over and over. But but we love it.
So you said you're based in Houston, obviously. Your first deal was in Fort Worth. Did you have a partner located in that area, or did you manage remotely, and kind of how, what happened about that really quickly? And then last but not least, what happened with that deal? That was kind of the last piece of that.
Right. Yeah. So, I'm in Houston, my partner's in Austin. So we're both 2-3 hours at least away from the site. So, we were just up there a lot. So for the first 6 months, we were visiting the property weekly. And a lot of times we'd be spending, overnight. So we would be up there for 2 days in a row. Our first deal, so we babied that deal, spent a lot of time on that deal to make sure it was successful. And then, we were already up there looking and underwriting and stuff like that, and touring property. So we were just in general up in the Dallas-Fort Worth area a lot. That deal ended up selling after a year. We looked at the market and we thought maybe it was, as John said, maybe getting heated, and we had already turned our financials around pretty quickly. After a year, we were already in year 3 of our pro forma. And so we decided at that time to sell it and kind of like get our profits while we can, right? So hindsight, we should have held on to it. The deal continues to do great.
You should have talked to John sooner about playing Pokemon.
Yeah, exactly.
The property's not selling them, right? So
yeah. So I mean, that kind of rolls right into, what was the mistake? That was one of the mistakes right there. But you never cry over money that you made, right?
I challenge that because it helps you propel you, though, right? You perform, you do well for investors. Investors like, know, and trust, and the best investors are the ones that tell their friends, right? That's what happens ultimately, and that helps you do the next deals anyways.
40-something% return after a year, or most of our investors. I hope all of our investors were happy. But you're right that it definitely helped prepare you on for your next deals.
Yeah, awesome. And last but not least, Shane, man, we put everyone through the gauntlet. So I think, Shane, all the right things to answer. Same kind of set of questions, man.
You guys set me up well. No, my deal, just a lot of common themes, like the rest of the guys. So, I think the first and foremost is it was a test of patience. And so, I think a lot of, we've talked about our deals and, we bought a 68 unit, a 92 unit and whatnot. But I think, what folks on the line need to understand is that, it takes time to kind of build up to that, right? And, kind of building your team and setting your criteria. There's a lot of steps, right? It's not a complicated business, but there's a lot of moving pieces. And it's definitely a team sport. So for us, our first deal was a 125 unit deal just south of Houston. So a secondary market called Alvin, Texas. And this deal we bought off market. So it was a deal that, you know, I had come across and, you know, we had offered on it, you know, it met all of our criteria at the time. And, you know, we had offered on it the first time around and we, you know, like it happens often, right? We didn't get the deal the first time. And so I think, you know, we had the opportunity to say, hey, you guys want to step up and increase your offer. But we just stuck to our criteria. And then lo and behold, you know, 6 weeks later, when that first buyer couldn't perform, the broker came back to us. And so, you know, that deal, it was me, my partner, our co-founder of Catalyst Equity Partners. And, you know, to Ben's point, you know, we, you know, obviously we had business experience, you know, professional experience. We had single family experience, but we did not have, you know, multifamily experience, right? So, you know, we brought in a very experienced third partner on that deal to really leverage, you know, his resume, help us get the loan, also build the credibility with our investors, right? I know one of the questions that was presented was, you know, kind of how much money did you guys raise and how was raising the money? And I think Ferris kind of touched on this briefly. It's, you know, you don't buy the deal and then all of a sudden, you know, the money just shows up, right? I think there's a process where you're building relationships, you're networking. So, you know, just like everyone is on the line right now, you know, I spent about 2 years prior to even doing my first deal, just getting out there, shaking hands, telling people that this is what I want to do and, you know, meeting like-minded people. So at that time when it came to raise $2 million for that deal, right, people kind of knew what your goals were. You know, they already, you know, people invest in folks they know, like, and trust, right? So it helped bridge that gap. And so, you know, going back to, you know, my point on patience, right? So my deal was in 2017. You know, we had it under contract in June of 2017. We were just about to close a week before. So typical multifamily closings, you know, 60 to 75 days. And for the folks in Texas know, in 2017 August, Hurricane Harvey hit, right? And so literally a week before, you know, closing, you know, we're scrambling and, you know, it's our first deal and I couldn't get out to the property offered, obviously. I had just moved to Texas at the time. And I still remember like reading the contract, like, you know, clauses like act of God and natural disasters and stuff that you really just gloss over the first time around, right? And anyway, long story short, you know, luckily the property didn't flood, but, you know, we had to change lenders, right? So we were going with a government-backed loan, agency loan. You know, the government got, you know, I guess a little skittish on Houston and after but the property kept performing well. And so we had to pivot really quickly and essentially find a bridge lender, you know, that enabled us to close in 30 days. So, you know, all said, it took about 4 months to close that deal. And, you know, it was obviously a lot of due diligence, investor communication, keeping investors abreast of kind of what was happening. And, you know, obviously, you know, we had a decision to make to continue going forward with the deal and whatnot. And I think, as, you know, Mike and Ben said, you know, your first deal, I mean, all deals, obviously, you need to perform, but your first deal is very crucial in kind of beginning your career, right? And so, you know, we bought that deal at a very low basis in Houston. And, you know, property kept performing and we kept getting pretty good debt. And so we closed on that deal in 2017. And so started operating that deal. We did have some challenges on the management side. So we third party managed our deal. And so just kind of, you know, using our business experience, you know, kind of made some good decisions to change up management companies. And then, you know, finally, you know, we got the one after, you know, third time's a charm. We got one that was, you know, kind of knocked it out of the park and really helped us execute our plan. And in less than 2 years, we sold that deal, you know, and, you know, there's a lot of other lessons learned we could talk about. You know, in hindsight, the loan that we got actually was beneficial to us because, you know, we actually we were able to sell with 0 prepayment penalty, which, you know, for most people in the commercial real estate space, you know, that's, you know, not too common, especially when you're going after agency debt. And so, Our investors did very well. They were happy. And, it was, like Michael said, it's just kind of an experience to kind of get your credibility out there to go full cycle. And then just personally, strategically, we started focusing more on Dallas. So that was another reason why we exited that.
Speaking of the loan, right? One other interesting thing. So you mentioned that you went from a agency to a bridge, right? For those that don't know, agency usually has big prepay penalties. Really understand what that means because it doesn't matter until it matters. And then you end up, it's a multi-$100,000 mistake. Ask most of these guys how they know, right? But with Shane, in your example, you had to jump to a bridge lender. And more importantly, I remember this happening, is you had to jump to a deal that you were having personally, right? So that shows how much you believed in the deal, right? And this gives that extra level, like this guy is on the hook no matter what happens with this deal. This guy is really motivated to get this deal humming, right?
Yeah. No, and I think that's very similar to also skin in the game and just having your sponsors know that they're in it to win it, right? And so we looked at that deal. We looked at our risk and, obviously the upside of the deal, but more importantly, the downside. And, me and my two general partners deal, we felt very comfortable with the risk. We personally signed on that loan. And I think that, gave investors a vote of confidence, that we, basically had our I's dotted and crossed.
Yeah, no, absolutely. Well, so that was helpful. So I want to shift gears a little bit, right? I was on a webinar earlier with Bruce Peterson, who I guess he has a book. I've never heard of this book, but it's called Syndication is a Bitch, right? And I really, and I want to get to that's kind of a little bit what Ben hit on, but why does he title his book that way, right? I know we've all, you do that first deal with that honeymoon phase, right? Oh, it's all new and exciting, but then you get past the closing, get into kind of the operations of it, right? And whether it's the first deal or the last deal that you guys have done, I guess what's interesting for people to hear is maybe for each of you, what are the 3 worst aspects of syndication, right? What makes it a bitch, I guess is the real question. So Shane, I want to maybe ask you that question first.
Yeah, no, it's a good question. I think, there's a lot of kind of, rah-rah stuff and whatnot, but at the end of the day, you're running a business, you are entrusting you with their money. And I think, there's a lot that happens behind the scenes. And so, it's, when I went into real estate, and it's still obviously the goal is, obviously passive income, having, more time that I could control, but, I work, just as hard as I used to work, and probably a little bit more. And I think that it's just a lot of process around this business. Right. And so, I think as you grow and you have the second deal, you can start building teams and start delegating. But, in the beginning, you're wearing all hats, right? Janitor, all the way through the CEO. And so, there's a lot of admin stuff that you got to do. So, for example, previously, our first deal, we had 30 investors or 35 investors. And, every year you got K1s to do with your tax, folks and, getting those out on time. And, we didn't have a portal before, so that's very manual, right? And so that's challenging. The other challenge is that, to Ben's point, asset management is really where you make your money, right? It's all about execution. Obviously you have to buy right, but then you also have to perform. And so, you're relying on a third party. And so, you don't have control over those employees. And so, just kind of making sure that you understand, how to make them execute, and, kind of having that kind of win-win, kind of partnership with them is tough in the beginning, right? Because if you don't know what you don't know, and if you don't got good partners and a good team, you don't know what questions to ask, right? You don't know where trends are going off track and whatnot. The last part is, it's tough to get deals, right? I think it's a lot of work. But I think that's why, the guys that are on the line, the other syndicators, you got to put in the work and the results will come, right? And sometimes it takes longer than you think, but you just got to be consistent and, it will definitely pan out.
Awesome. And like Bradley said, I love seeing y'all. More hair on the face, less up top. So, it's painful, right? So John, same kind of questions to you, man. Outside of just, the exciting buying the deal, right? What sucks about it? Or what are the kind of the takeaways and the things that people need to really be aware of? And I know I might have tripped you up, John, kind of looped you back around since I thought you thought you might be at the end. I think you're muted, John, by the way. There you go.
Oh, there you go. Yeah, I look at this business like a three-legged stool. So the first leg of the stool is, finding the deal. You got to go out there, you got to build broker relationships. You've got to, have relationships with sellers. So the first leg of the stool is find the deal. The second one is putting the capital stack together, which is both the debt as well as the equity raise, the capital raise. And then the third point, as Shane mentioned, is the asset management. There's challenges on all three, just depending on what you're good at and what you're not good at. And so one of the things that really has helped me kind of build my portfolio is to partner with the right people. You can try to do all three legs of the stool, but if you try and do that on a big deal on your own, you're gonna fall flat on your face on one of those three legs. So partner with somebody that you have a relationship with that offers complementary skill sets to what you're good at. So if you're really good at operations and you're really good at asset management, but you're not really the guy to go out there and raise the capital, then go partner with somebody that has those relationships. Or if you need to get into a market but don't have a lot of broker relationships, but a good buddy of yours that has those relationships to find that next deal, then partner up. And I think that's really what has allowed me to kind of scale quickly to these 3,100 doors. I partner with a lot of different folks and kind of offer different skill sets depending on what's needed in the deal. But there's challenges in all three legs of the stool. Raising capital is definitely can be a challenge. It takes a lot of time. It takes a lot of effort and kind of building relationships and building trust. I'd say also the third leg of the stool, which is operations. That's where the rubber meets the road. If you can't operate the deal, it doesn't matter, how good the deal is or where it's located. You've got to really stay on the ball from an operations standpoint and really dial in on those P&Ls and all the other metrics associated with the business.
That's a good point. I don't know if I've ever seen a three-legged stool, man. I feel like they're all four, but now I'll pay attention to it now. All right. So Michael, I want to ask you the same thing. And I know John and Shane kept it a little bit PG, right? I mean, really get into like the guts of it, right? What sucks about it? That's maybe the thing I want to understand, have people understand, I guess.
I want to touch on a bit of what John said before I dig into that. I think John talked about partnership, and he makes it sound real easy. Partnerships are hard too, just like any other stuff. John has a unique ability of being able to work with a lot of people. So I want to make sure people understand that's a super viable strategy, especially if someone of John's skill set. But just like any of the other things we talked about in terms of equity raise and finding deals and stuff like that, those are all unique skill sets. So if that is your strength, then definitely that's something you can do. But that's also something really hard to do, working with a whole variety of personalities out there, right? So in terms of I think they all touched on it. For me, I guess my biggest pain point, and maybe retrospectively, that looking back, maybe it's because it's my what I'm weakest in, which is on the operational side, right? I spend a lot of time and energy on that. And that's absolutely what I hate the most, is dealing with the third-party property management company. So acting as an asset manager, you feel, as Shane touched on it, John touched on it, and everybody knows you have to. They're your partners, and you have to trust and rely on them. But that's really hard to give up, right? Because that's really where your reputation lies. And you feel you have the least amount of control most of the time. So that becomes a very frustrating point of yours. So there you go. For me is the operational side of it. The other stuff in terms of going out there, meeting brokers, going out there and meeting investors, that usually involves a lot of eating and drinking. And I love that part of it. So all the other stuff is harder to
The fun
sell.
part of it, man. But yeah, to your point, it's almost unfortunate, right? You trust this property to, property management company that a lot of times doesn't matter, but also it's, usually a 40, 50, 60, $70,000 salaried person that's responsible for this, 5, 10, $20 million property, right? And so that is kind of the scary part. And, to Shane's comment earlier, what systems can you build on top of that to kind of help keep everybody accountable, right, regardless of who that person is? So, yeah, I completely agree with that.
Well, Mike stole my thunder. That was going to be my first and foremost thing about what sucks about syndication and what we do in multifamily and apartment investing is it definitely the third-party property management companies are horrible. You have to kiss a lot of frogs to find the right ones. So I'd say that's my number one complaint, right? And that's ultimately why we decided just to create our own. But the second one, and it's not a far second, it's pretty close behind, is the lender servicing, right? Because a lot of what we do, all the guys that are on this panel, right, we do value add deals. We have rehab, dollars that we have to pull out. If that's escrowed and you have to work with the lender to get your draws and get your money, sometimes that could take months. I mean, we're not talking, that's not a 2-week process. Sometimes it's a 2, 3, 4-month process. Well, in the meantime, you've got to juggle all your cash flow management, right? You've got to pay your GC out of some kind of money. You got to wait for the lender to reimburse you. That all mucks up your business plan because you're trying to turn a certain amount of units. You're trying to get a certain amount of rehab done in a certain amount of time. And they're just delaying the process. They're holding on to your money because usually it's the lowest rung of people that are at the lender are going to work on the servicing department. Sorry if anybody's on the line that works in the servicing department, but we haven't had a great experience with them. And I think we have 6 lenders that we've worked with over our career. So this is not just isolated to one lender. They're all pretty equally bad. And that can hurt from an operational and an asset management perspective, right? Because you're trying to blow and go. And when you're having to wait 3 or 4 months, that can really put a crimp on your business plan and on your cash flow. Because you got to fund that out. Your GC is not going to wait 3 or 4 months to get paid, right? He might suck it up for a month, 6 weeks because he understands the process. After that, he's going to start barking at you, and you want to try to avoid a lien. So who's going to be stroking that check? It's going to be the GP, right? So I would say my third, and this is just an annoying thing. I hate the lender paperwork when you're going to buy a deal. It's such a paper chase, right? Now, luckily, people like Anton, he helps us kind of shepherd our way through that process, right, at Peak Financing. But ultimately, it's still, you have to buckle down and you have to do a lot of paperwork. You have to sign a lot of things. And that's probably the number 3 thing that I hate.
I don't mind the acquisition paperwork, man. It's that servicing stuff. So
yeah, that's definitely.
Here can kind of nod that the servicing, it sucks and it's a painful process and it makes the work sometimes twice as much work.
Yep, absolutely.
Awesome. Well, I want to be respectful of everyone's time. So I know we have about 15 minutes left before we do breakouts. And so what I wanted to do, actually shift gear and ask one more question and then open it up for Q&A. So people feel free to leave your comments and I'll go ahead and kind of read them out loud and let the panelists answer them. And if we get a lot of questions, I'll make it lightning round. So whoever answers it gets a 5-second answer. So we can kind of expedite it. I know Ben is long-winded. He likes to keep going. I know him really well, so I can make that joke. But really a question.
Do we lose these guys again?
Yeah. They'll be back.
Michael, you guys there? John?
Yeah, I'm here.
I think we're
All right. Well, that's why I connected from my phone too, just to be safe. So I'm glad I had both. Well, what I was saying is this is a question maybe more for Michael and John, and maybe Ben and Shane. You guys can chime in if you guys would like. But kind of obviously having done syndication, having done apartments, right? You guys are now transitioning and looking at new development, right? What's the allure there? What's the reason there, right? What's kind of made that attractive, and how does that compare against kind of the traditional buying existing assets that you have been doing?
I'll start off. So I started looking at new development probably about 3 years ago now. And the primary reason at the time was, again, the pricing was getting really up there. Cap rates were continue to be compressed on the value add deals. So my analysis kind of showed the price to build versus the price to buy, excuse me, was continuing to narrow. And so I started looking at new development deals. And so that's the primary reason for the shift. I still like the value add play, but did that pivot about 2 years ago. And we've got a deal in Wiley, Texas, which is just east of Plano. And then Michael and I have a deal down in Katy, Texas, in the Houston area. But that's the primary reason for the pivot, was because the price to build versus the price to buy was narrowing. The primary differences, I guess, is, you know, when you're building, it's pretty much an 18 to 24 month time frame once you have permits ready to go. So it's a bit of a long game to kind of get into the deal and wait for that apartment to be built and stabilize and cash flowing. So that's, I guess, if you call that a negative, that's a negative. There's no cash flow in that 18 to 24 months. I think the biggest positive is the margin. You've got a lot more margin in the deal if you buy the land right and buy the deal right. And what I always say in new development is you're buying dirt by the acre and you're selling finished product by the square foot. So that value add chain, it's almost the deepest value add play you could participate in new development. So that's one of the primary pluses in new development. I'll hand it over to Michael.
Yeah, Michael, anything to add to that?
Yeah, I mean, as John said, I mean, we're in the value add space, and you can't get more value add than taking something from dirt to something built out. And then John mentioned that the price of a lot of the B and C stuff that we were traditionally buying was getting up there. I want to also add that there's the other side of it. It's the operating cost of it. I mean, I have 2 properties that are built in 2001, 2003, 2005, so newer properties, and I know the difference between operating that versus a property that's, you know, built in 1960s and 1970s, and it's a much easier property to manage because it is newer and because you're not constantly running into leaks and this and that. So conversely, you build something, and even if you come out with very similar or you definitely have a premium in terms of cost per unit, but your overall operating expense to income ratio is also much lower on a traditional C-class property. You're looking at 55% ratio, sometimes 60, 65, depending on taxes and insurance is super high. But you're definitely looking in the 40s and stuff like that if you're looking for a brand new property, right? I mean, your HVAC's not going to break down for another 10, 15 years, and your roof's new, etc. So you're not dealing with all those ancillary costs. So that's the other factor for why I like it.
Come on, Michael, you don't like dealing with AC and plumbing issues? AC and plumbing are the 2 things I think will kill a deal. All right then. Well, so I will shift gears, and it's hard to do this from my phone, but I'm going to make it happen. But I guess, you know, I want to start to go through Q&A, right? So I think to people that are new, right, I think to me, usually Q&A is the most valuable part, right? You can ask those interesting questions, those hard questions, the things that maybe, you know, you're wondering. And so feel free to ask. I mean, I know all the guys on this panel are pretty genuine, transparent guys. So I think most questions are happy to kind of dig into, but please go ahead and, you know, write your question, and we'll kind of read them out loud and then see what people, you know, kind of answer. And so I think maybe I'll just go ahead and kick it off. So, and I'm trying to skip through things that we may have answered, but, you know, one question was, what kind of demographic data do you guys study when trying to evaluate a submarket you're not familiar with?
Yeah, I mean, I could take that. So, I mean, there's, you know, obviously we look at multifamily from more of a supply and demand perspective for me. So we're always looking at areas that have growing populations and more importantly, jobs, right? Because jobs, you know, bring people and then, you know, increase the need for property. So that's one thing that we always look at. You know, obviously, you know, landlord friendly states and whatnot. And then for us, you know, personally, we look at kind of, you know, we're in the value add space. So we're going to be pushing rents most likely in all of our deals. And so we want to make sure that the areas can support, our projected rents, right? So, we like to look at a certain, base income, right? And, there's kind of rules of thumb out there in terms of, how much people should be spending towards housing. So we'd like to see that, the median income of that area can support, kind of the rent that we're going to charge, kind of on a 3-to-1 basis. And so, and then, we're obviously looking for things, at least, pre-COVID, just areas that have, lower unemployment rates, higher than average job growth, et cetera. So those are just kind of a couple of the high level ones.
All righty. And then I guess I'll keep going then. So, next question, this was specific for Shane. Shane, how did you find your first off market deal? 10 seconds.
10 seconds. It was a lot of calling. Like all these guys said, I mean, in the beginning, I was actually living in Chicago at the time, calling brokers in Texas, and didn't have a track record. I'm a single family guy, and they didn't really take you seriously. And you're gonna have to get used to kind of getting rejected, right? I mean, at the end of the day, it's kind of a sales and marketing business. Even though the broker is selling you a deal, you're also positioning yourself, as a qualified buyer, right? And so, I think the education helped tremendously, and I just kept learning, and I was pretty persistent, but also always followed up with what I said I was going to do. And so I moved to Houston, and then just kept building the relationships, gave brokers feedback. I'm very quick to respond, give them feedback whether I like the deal or not. And then, one thing led to the next, and 12 months later, a lot of these brokers that wouldn't pick up my phone call, a year prior, a lot of these guys are my good friends now. And so, yeah, just through that, one of those relationships, we kind of got a deal that was a pocket listing, if you will. And so, we kind of had a first look and really, with our relationship, at least got our foot in the door. And then we brought the resume, with our third partner to kind of seal the deal.
All right. Next question, John, how do you track the market cycle? You mentioned at the beginning, I'm sure your background helps, but for a non-economic background guy, how can we track the cycle of the market?
I'm constantly kind of looking and reading articles and reading books and podcasts. I'm going to give a plug to my Facebook group, Texas Multifamily Investor Network. If you're on Facebook, I'm literally posting an article about multifamily or the economy or cycles every day on that Facebook group. So it's just kind of keeping an eye out for what's going on in the marketplace, and just tracking the different data points out there, whether it's GDP growth or population growth, job growth. I'm very much hyper focused, like I said, on Texas. And so most of my research is based on the Texas market.
All right. So I do recommend everyone join John's group. So Texas Multifamily Network. So definitely a good group. Obviously, I think a lot of people hopefully are aware of that, but I highly recommend people joining it. Next question. When you're looking at a location for a new build, what do you look for? So Michael and John, I guess that's y'all's.
Go ahead, Michael.
Yeah, I mean, I think, it's very similar to what Shane said. I mean, the drivers are generally very much the same, right? You're still looking for that job growth that drives that population growth that can drive that rent growth. You're looking for, but in this case, new development, most of the time when you're doing new development, you're going to be building a higher class property, just because most of the time the numbers don't work without some sort of government help, if you will, to kind of build something below that. So you're going to be building class A market rate type property. So then you're also going to have to find an area that can support that, an area that those type of people that would like to live in. And so you want to make sure that they're in a good school district. You want to make sure that they're close to those type of jobs and the company that can that has those jobs that meet, I guess, the tenant demographic that you're trying to rent at your property. And then in our case, we have a mixed use property, so we have a portion of it is retail. So then we have to make sure that the land is located in an area that get the amount of traffic that would be attractive to our retail tenants that would lease from us, and that they would have enough traffic to support their stores.
All right. And let's go next question. So how do you find good deals? Who wants to answer that one?
You got to kiss a lot of frogs.
Kiss a lot of frogs and do a lot of underwriting, right? It's the kind of maybe the meta.
It's a numbers game. Yeah, it's a numbers game, right? You gotta call enough brokers in the market that you want to be in. You got to make enough offers. You got to do enough tours. You know, that's how this kind of works, right? You know, ultimately you'll finally find that 1 in 100 that really makes sense, and then you go after that one as aggressively as you can, right? You know.
Yep.
All right, let's keep going. Let's see. So we talked about that one. Glad to see the Houston Juggernauts. Yay for the Texas Juggernauts. All kind of branded for everybody. One question from Omar. Why not build a property management company to manage your own deals, kind of a vertical integration? Who wants to answer that one? Ben, you want to answer that one? And maybe Michael, you can answer the opposite, or maybe what makes it hard is maybe the question. So
I think we lost Ben.
Ben, I think we lost you too. Yeah, I
Can you
don't
hear
know.
me?
Yeah, we can hear you now.
All right. So I think ultimately you have.
All right, Ben, we lost you again. Here, I'll answer for Ben. I think part of the because I am Ben's partner. So part of the problem with starting property management is that it's actually very hard to do, and I think most people on this panel, we're good at other things, and so ultimately starting a property management, you need a good team, and also the economics have to make sense, right? It doesn't make sense with 1 or 2 deals, right? And doing kind of up and down the stack and having the whole structure, and building it out to be a third party. So for us, we did do, we brought property management in-house, but we're only able to do it, A, once we grew to a certain size, and then B, really bring in, a rockstar team that knows that space, that can do all aspects of that, right? So that's ultimately, I think, why most people don't do it, because it's actually very hard. I mean, having done it now, I'm like, man, I see why a lot of people really fail at it, right? And I think, the other part of it is, again, it doesn't make sense until you're at a certain size. Let's keep going then. So Scott McKay, 4 months for a lender draw. Yes, that is actually true. Took forever. One question, this is actually a good one. And I'm going to do maybe 2 more questions, and then we're going to move to breakouts. How has your underwriting changed in the post-COVID world?
Yeah, I mean, I underwrite extremely conservatively right now, just because I'm more of the W type of recovery right now. If even that, and I'm constantly revising that thought. But I'm definitely not a Nike swoosh recovery guy. Definitely not a V recovery guy. I think there's more to come. So I've been underwriting really conservatively, which means that not a lot's working for me right now.
Anyone else? I guess I'd love to hear maybe Shane.
I know. I mean, I agree with Michael. I mean, there's a lot of uncertainty there, and we've seen the bid-ask gap being really wide. I think the reality is that most of these deals don't work without rent growth, and organic rent growth is it's hard to predict in the next 12 to 24 months. And so, we're really looking at deals that, have some distress, or, there's truly under market rents, right? Where we could go in from a value add perspective, do some improvements and whatnot. But yeah, I mean, we've kind of kept, kind of no rent growth for the next 12 to 24 months, based on the submarket. And, just kind of, all just trying to be very conservative. And again, I think you also have to understand, kind of who your investors are and what your goals are, right? Because, as a syndicator, we're raising money from investors, and, we're projecting, and our reputation's on the line, and it's different than if you're going to go buy a deal by yourself. There's a few deals right now that, if it was my own money, I'd probably go buy them because I have a long-term vision, and, I'm not so concerned about year 1 or year 2 cash flow, right? So I think, this business is all about kind of a puzzle and putting the pieces of the puzzle together. And so, you kind of maybe got to change your strategy a little bit, when you come to times like this.
All right. And last but not least, so the question is basically, how do you know an area is in the path of progress? Don't answer all too fast.
Just tracking the population growth and at the city level. So for the Dallas area, you look at Dallas. If you go north, you go Dallas, Addison, Plano, Frisco. All has been built out. What's after Frisco? Well, you got Prosper, Salina, Gunter. So you just got to track the trend lines, and if that's where you want to play, pick the next city that's going to be the next one that's going to really explode from a population growth standpoint.
Yeah, and I would say, talk with your local single family guys, wholesalers, the title people. They're doing a lot of deals. They know where a lot of those deals are happening. And so they'll have probably a better pulse of the market than you will from necessarily a multifamily. We do anywhere from 2 to 5 deals a year maybe, and those guys are doing 40 deals, 50 deals a year, right? So.
Yeah. And if you don't know, talk to Michael and John and they'll tell you. All right, well, let's go ahead and so let's wrap it up. So next thing we're going to do, so maybe really quickly, if each of you guys can kind of maybe quickly say how someone can get a hold of you, right? And after that, I gave Anton host access since I can't do this from my phone because my internet's not cooperating. But basically, we'll break out into breakouts. And so we'll break out into groups of about 8 people. And really, gives people a small group setting to kind of get to know each other. So I think this is honestly one of the most valuable parts. I'll highly recommend people stick around. But really quickly, Shane, do you want to kind of maybe see how people can get a hold of you?
Sure, yeah. So you can reach me by email. It's Shane, SHANE, at catequity.com. Or just visit our website. We have a contact us form there. It's catequity.com, catequity.com.
All right, Michael?
Yeah, so you can reach me at michael@bayoucitygroup.com. I also posted a Calendly link in the chat. If someone wants to schedule a 30-minute call with me, feel free to schedule it using that link.
All right, John?
Best way is on the website, Texas Multifamily Investor Network.com. You can reach out via the website, and I'll be happy to have a conversation with anybody that's got additional questions.
If you guys haven't picked up, you should definitely join that meetup group. That's John's point. If you want to talk to him, that's the only way. All right, and last but not least, Ben, you want to quickly kind of let people know how to contact you?
Yeah, hopefully before I drop off again. So Ben at disruptequity.com. We also have a website, disruptequity.com. Love to talk shop and appreciate everybody's time.
All right. Well, thank you guys to our panelists. I think that was definitely informative. I think a lot of people really enjoyed it. I had a lot of private message people just thanking us for it. So thank you all for that. But we'll go ahead and transition to the breakout room. So Anton, you want to go ahead and kick us off into breakouts?
Yeah, sure, we'll do that. So we do it for roughly 10 minutes, right? And then we come back in.
Yeah, so we'll do this for about 10, 12 minutes, and then we'll bring everyone back and we'll call it a wrap.
Sounds good. See you there.
All right.
Hey, I just got kicked off the meeting. Is this the breakout session?
Well, that's one of them. So we have 10 different rooms and it's all randomly assigned.
I see. Is there a topic we're discussing in the breakout session? I'm kind of new to this discussion.
Not really anything you want to ask, right? So it's, I would say it's a combination of just introducing yourself and your interest and anything else you want to talk about.
Are you a real estate investor in Texas or?
Well, I'm on the financing side. So we arrange financing for commercial real estate. Also have been on the investment side for quite some time. Right. So I'm originally from Switzerland, but I lived all over the world. But the last 15 years here in Texas. What about yourself?
Oh, I've been to Switzerland. My uncle lives there.
Oh, okay, cool.
What
What
part
part
of
of
Switzerland?
Switzerland?
Huh? He's in Geneva.
Oh, okay. Very good. I worked there for 2 years.
Uh-huh.
Yeah, it's a nice place.
Your accent is German.
I'm from the German part, yes. So I'm from the place behind me, which is Lucerne.
Okay.
Yeah.
Yeah, I thought that might be a European background.
Yeah.
You with a Swiss bank then, or?
I was with UBS, yes.
Uh-huh.
Yeah. Yeah. So what is your uncle doing?
Oh, he's long since retired. He's very
Oh, okay. Yeah. Okay.
I think he was working with Church of the Brethren Volunteer Service and then World Council of Churches in their office.
Oh, okay. Very good.
But I don't know what exactly he was doing. Kind of networker before all this internet stuff.
Yeah. Yeah. So where are you based here in the US?
I'm in the greater Los Angeles area.
Oh, okay. Yeah. And have you already been investing in multifamily or just looking at it?
Looking at it, hearing a lot about it, and kind of think I might be too small. I have an auto sales background.
Well, there are plenty of people that that thought that they are too small and they were able to partner up with others, right? So that's the beauty about multifamily when you're in the syndication space. You really can do it even without prior experience and or significant amount of capital, as long as you bring some skills to the table, right? So some people are more focused on raising capital, others are helping with the due diligence, with underwriting, whatever it might be, right? So one of the people who also are co-hosting this Texas meetup, Ronnie Phillip, right? So he's a young guy. He joined up with Disrupt Equity and he was just hustling away, and essentially was able to be part of a couple of deals that they have been doing, right? And he's only didn't bring a significant amount of capital to the table or experience, but he was willing to learn and help. Yeah.
So are you in Texas now?
That's right. Yes. Yeah.
In the Dallas Fort Worth area,
Dallas,
or Houston?
yeah, Dallas. Yeah.
Okay.
Yeah.
It's a big area.
Yeah, obviously that's where it all started out for the multifamily syndication around 10 years ago. And so that's now a lot of people have stopped doing it in Dallas Fort Worth because the prices have become a little bit too steep. So they moved in other markets like Georgia, Atlanta, Florida, and some other places.
I see.
Yeah.
So are we syndicating investors? Generally speaking, I mean, I don't travel that much anymore. Currently with the pandemic, I don't really want to travel too much, and
Sure.
I'm more interested in investing in areas I know. But of
Yeah.
course, I'm in a very expensive market.
Yes, yeah,
I-
it definitely is. A lot of people from California they invest in Arizona, like Phoenix, right? Because it's still somewhat within driving distance. Obviously, not a short distance, but it's still within driving distance, and I feel a little bit more comfortable there. But there are also a lot of investors that are willing to jump on a plane as long as it's a day trip, so they leave early in the day and then come back at night, right? Um, it's only easier when you can invest in the market you're comfortable with initially, right? So I certainly would not recommend to go outside of your market without partnering up with someone who can help, right? So at least to share the burden.
Yeah.
Yeah.
Um,
Hi, everyone else. So you can unmute and talk too. So it's not just Tim and I who need to talk here. Hi, John. I see that you're on too. So how did you learn about multifamily masters, Tim?
I've been watching a lot of YouTube content, LinkedIn content, blogs, TikTok, all sorts of different social media exposures. Since the pandemic began, I've gotten I've been prospected a lot by Grant Cardone's organization.
Oh, okay. Yeah.
And then I've followed Deeper Pockets podcast a little bit. All these YouTube gurus, I don't know how to really sort them out as far as how much credibility I give them, but one thing I think I understand is that a lot of it's about underwriting the deal properly, analyzing the deal properly.
Yeah, that's right. That's only that's a big deal, right? That's definitely important.
Putting the protections in place for the investors. What is a certified investor? Is that right? The right term? What was?
It's called an accredited investor, right? So you have accredited investors and you have sophisticated investor. Anyone should be sophisticated. But when you have accredited investors, then you have the ability, if you strictly market to accredited investors, then you have the ability to publicly market a deal. Whereas if you have a combination of sophisticated and accredited or just sophisticated, then you cannot really market it publicly. So that's the main difference.
By market it publicly, are you talking about when you sell the
well, in, let's say, on Facebook or on LinkedIn, or something like that, right?
So how does one become an accredited investor?
It's your income as an individual. It's 200,000 for a single individual, 300,000 of yearly income, and for a couple, or 1 million in net worth. That's essentially what an accredited investor would be.
So it's somebody with some skin in the game as far as.
Yeah, so that's not really that it would be skin in the game. It's really more like that someone is allowed to invest in a deal that is for so-called accredited investors.
Mm.
So that's really the only difference there. But by the securities law, you have one offering the 506C that is specifically just for accredited investors, and then the 506B, which is a combination, right? And once you have a so-called 506B, you're not allowed to publicly market it. So you need to only market it to your contacts with whom you already have a relationship with, right? So that's the big difference.
So assuming one has, and it's either a net worth over a certain amount, or that over 200,000 in personal, or 300,000 household income. Is that?
Yes, that's right. Yes, so that's
It
right.
doesn't have to be both and.
Yeah, yeah.
And it's determined by the SEC, or
The SEC, yeah, the Securities Exchange Commission, right? So that's their rule, but you determine it based on your own income. So no one is determining, right? So it looks like we are just running back to running out of the breakout. So
I found your responses informative. I appreciate it. Nice meeting you.
Yeah, pleasure meeting you. Right. Bye, Tim. Okay, so I think it's another minute or so, right?
Hello, Anton. Can you hear me?
Yes. Hi, Harry.
Hey, how are you? How are you? Hey, thank you so much for hosting this. So I'm kind of new, super new to this actually. Like I've been like around like a year, just mainly in single family homes and trying to but it seems like, so like you guys are based in Dallas, right? Is that correct? Like you?
That's correct. Yes. Yeah.
And you guys are mainly part of the same team, I guess, like you, John, and
well, we are not of the same team. We are just co-hosting that Multifamily Masters here in the Dallas market, right? And Ben and Ferris do it down in Houston.
Okay, gotcha.
All right, we got everyone.
Yeah, so we are all back.
Cool. Did people like that? Was that valuable?
Yep.
Yes. You'll make a friend or two, and if you didn't make a friend,
can we go back?
ouch.
Very valuable. Thank you guys very much.
Yeah, I think
Hopefully
we
you
had
guys got to exchange some contact information. Like we said, real estate is a team sport. We highly recommend people, get to network, get to know other people, right? And, figure out ways to add value and build true friendships, right? And partnerships. And so that's maybe my closing statement for everyone. So, thank you again all to our panelists. I apologize about the technical difficulties. I am back on the computer. The internet is working, but it's been fine all week, but then we have that obviously worse timing. But thank you all for bearing with me. And again, thanks to our panelists, really appreciate it. And we're going to try to do this once a month, right? So it'll probably be, the second Wednesday of the month, I think is what we're trying to do. And so definitely everyone keep an eye out for the next one, and we'll try to, vary it up, bring different panels, different speakers, and always come with questions. So thank you all very much, and we'll call it a wrap.
Thanks, everybody.
Thanks, guys.
Thank you.
Hey, thank you guys.
No
Have a
problem.
good night,
Yes.
everyone. All right.
Stay
See you,
safe.
Shane. Good to see you.
You guys.
Ben.
Yep.
Stay safe, guys.
Thanks.
Bye-bye. See you.
Yeah.